Okay, hi everyone. This is going to be the second video for the PowerPoint for Chapter 7. So I'm going to say we got through about slide 50 here. We got done talking about accounts receivable. Now, right, let's talk about notes receivable, right? We said really the difference between an account receivable and a note receivable is whether it accrues interest, right? The formality of it, and those kind of situations, right? So when you have notes receivable, right, they can be short term or they can be long term. Let's kind of unpack these one by one, right? We're starting with short term. That's great. We said that, hey, they do charge interest, right? And we're going to have to calculate interest on that, right? And it can be for a fraction of a period, right? So it's not always going to be like, oh, it's like a 1 year note and calculate the interest for 12 months, right? It might be like, oh, 3 months have passed. Please calculate the interest. So let's look at an example here to kind of give this some numbers. It says, right, we have a shoe company. They manufacture athletic shoes. That's great, right? Looks like on May 1st, right? They make a sale of some shoes and they agree to get a note receivable for that, right? Hey, the customer will pay you later. And specifically later when they pay us, it's going to be 6 months and $700,000. There's a 12% rate on this. And essentially what they're saying is, hey, pay us in, my line's not straight there. Please pay us in 6 months, and when you do, pay us not only the 700, but also pay the interest on top of that, right? So here we are on 11/1. We want our money, right? And we want the interest on that. How do we do the journal entries here, right? So 5/1, right? The day we make the sale of the note, debit note receivable, credit sales revenue, right? We made a sale here. That's great. How about 6 months later, right, on 11/1, whenever we get our money, right? So you think about it, right? We're going to first get rid of the note receivable, right? We teed it up. Now we're going to get rid of it. Likewise, there's been interest, right? We've had interest over here for 6 months, right? So we're going to have to use that formula, 700 times 12% times 6 over 12. Right? Why is it over 12? Well, the 12% is based on an annual rate. So to keep it apples to apples based on annual rate, 12 months, 6 over 12, 42,000 of interest revenue. And accordingly, right, when they pay us back, what the face is plus the interest, right, that's going to be 742 debit cash, right? So that was pretty straightforward. Let's look at a modification of this, right? So here they're saying on 8/1 we make the sale. That's great. 6 months later, right, we'll collect, right, we'll get our money, right, the face plus the interest. The difference here between the last one is, we got our fiscal year end, right, 12/31. So we got 8/1, 12/31, and then 6 months from the original there will be 2/1 year 2. How do we deal with this? Right, well, the upfront journal entry we've looked at before. Let's look at the 12/31 journal entry, right? Essentially what we have to do here is make an AJE, an adjusting journal entry to accrue revenue for, 5 months have passed, right? So it'll be 700 times 12 times 5 over 12, 35,000. Debit interest receivable, credit interest revenue. We aren't getting the cash yet, but we still need to accrue for it. Likewise, right, in February, right, February 1st, right, we're going to get rid of the note receivable, right? We're going to collect on that interest, right? And then accordingly, right, we will have the interest revenue that we recognize here for the remaining 1 month, right? Because it was 6 months, 5 of it we did over here, 1 month we got over here, right? So it'll be 7,000 there, and then we'll do debit cash for 742, right? Which is going to be the combo of essentially the money, right? The face plus, in this case, the interest, right? The basically for the entire period, part of which we've accrued over here, part of which we've accrued here, but we've collected the entire amount right here, right? So there's difference between when we accrue it and when we collect it. All right, they talk a little bit about non-interest bearing notes, right? They don't really charge a stated interest rate, but one of the things here on them, right, is they're going to have a discount, which essentially will represent the future interest revenue, right? And that discount account will be a contra account. Let's look at an example here again, give it some numbers. It's always better to see it with more examples. Looks like on May 1st, they accepted a 6-month, $700,000 non-interest bearing note in exchange for delivering goods that have a cash sales price of $658. Right, so you could see here, normally we sell this for $658. We're eventually going to get a note, a payment here for $700, right? So the difference there, right, that 42 difference is going to end up being our discount, which is essentially how we make money on it, right? We're going to make money from the sale, but we're also going to have some sort of implicit interest in there, right? So how do we deal with this, right? The sale is here on 5/1. We're going to collect 6 months later on 11/1, right? So here's the note receivable. Let's look at this, right? 5/1, what do? Right, so we're going to do debit note receivable for the face amount, 700. Credit sales revenue, right? In this case, consistent what its cash sales price would be. In the difference here, right, you can plug it. The difference between 700 and 658, or you can do the math on there, right? We're basically factoring in interest on it, 42,000. Right, and the idea there is that's the discount. It's going to be a contra account to the note. Here we are on 11/1, right? What's going on here? Well, in this case, right, we kind of teed up this discount. The 6 months have passed. We now need to basically get rid of that discount and recognize the revenue for the 42,000, that kind of implicit interest. Likewise, right, we get the cash at the end of the day, the 700,000, and then get rid of the note receivable, right? So the idea here is it's non-interest bearing insofar that it does not have a stated rate. However, because we have a difference between kind of what we traditionally sell it for and what we ultimately collect, that difference is going to act as a discount, aka an implicit interest, ultimately which we will recognize interest revenue for. You can look at this, not really concerned. They're just saying, how do you calculate the effective interest rate on non-interest bearing loans? It's pretty specific. I'm more concerned you get the basic ideas there. What's going on here, right? So let's look at this guy. Say they made a sale on August 1st. The December 31st, 24 adjusting entry to record the cash collection. Okay, so this guy right here, this is a variation. You can look at it. Essentially what they're doing here is, right, we have the sale on August 1st. They ultimately are going to collect, right, let's see here, February 1st of the next year. But just like we did last time, right, there's that sort of intervening fiscal year end of December 31st, right? So we're going to have to account for here 5 months of interest revenue, right, when we do our year-end financial statements there, make an AJE for that. And then for that remaining 1 month period, right, we'll accrue the remaining revenue from the interest component, and then we'll do the journal entry to get the note receivable off the book. So similar to the last example, except we have this like sort of intermediary stop sign there for us. Here they have, a long-term note receivable. So this is an important thing in kind of transition. We were just talking about short-term note receivables. We said, generally that's going to be less than a year. We said that, we have to be able to calculate interest on that. We talked a little bit about non-interest bearing notes. Now we're going to talk about long-term notes receivable. And the big difference here between the short term is we're going to have to factor in the time value of money, right? So when we look at this example, right, it says they sold shoes on January 1st, right, 1/1, accepting a $700,000 2-year note. Okay, so we're getting in a 2-year period here, right? So there must be 1 year and 2 years. So ultimately they're going to collect it right here at 12/31 year 2. How do we account for this, right? So let's take it one journal entry at a time. 1/1, right? We are going to have a note receivable for face, debit note receivable, 700,000. The revenue on this, right, because we're looking at a long-term note receivable, we have to take that future amount of 700,000 and kind of shrink it down into today's dollars, right? So it will be 2 periods, right? Because it's 2 years. Based on the facts up there, it looks like the effective interest rate is 12. We would use the present value table, 558, right? So debit note receivable, 700. Present value, the sales revenue, 558. The difference there will be the discount, right, of 141. Next, right, we're moving along here, right, we hit the end of year 1, right? We now have to account for, right, do an AJE for the interest revenue, right? That discount's going to recognize and essentially be interest here, right? So we will take essentially, the 558. It's 1 full year, so at least that's simple enough, right? We'll multiply it times the 12%. Essentially what we're trying to do is get this 558 here up to 700, right? So we're going to kind of marginally do that. In that way, we'll have interest revenue of 66,000. We'll get rid of the note for that amount. Next, right, we're going to move for another year, right? We're going to have some part of that that's an AJE and some of that we need to do for getting it off the books because, the whole end of the 2-year period has passed. How do we deal with this? Right, so on December 31st. All right, first off, right, we know that they're going to pay us the 700 and we're going to get the note receivable off the books, right? We teed it up over here in the beginning, we get it off for that amount and they give us cash for it. Finally, right, we have that remaining discount that we got to get rid of, right? In other words, we got to build this 558 up to 700,000. We got 66 of it so far, right? The remainder, the 75, will get us where we need to be, right? So one way you can think of it is like we're trying to get from here to 700, or you could do the math on it, right? It'll be the 558, what we started with. We added to that amount, right, the 66,000 on there times the 12% of another year. There's 75,000. get rid of the note as well, right? So if essentially, right, I'm pull up my calculator here. If we look at this, it's going to be the 558,036, right? You start with this guy, you add to it 66,964. That's great, right? Where it's 625,000. And then you add to that the remaining 75,000 over here, right? The combo of these three get us up to 700, right? So it's like we shrink it down, the sales revenue, and then we build it up slowly, right, to get it to that 700,000 amount, right? And it's going to represent sort of the financing, the interest component on it. All right, you can look at that MCQ. They then mention a little bit about you could potentially have a note received solely for cash. In this case, even though it might be a multi-year period, you're going to just keep it at the cash amount. That's like pretty simple. It's not very common that you would do this because like, why would you give someone 200 grand and expect 200 grand back? You normally would want like some type of interest income on that or more money, but maybe they're doing this like internal between two businesses or something, right? So the idea of is here, if it's solely for cash, just use the cash amount. All right, so we talked about initial valuation of a notes receivable. How about subsequent valuation? Right, well, essentially, if you remember with accounts receivable, right, we said we have that sort of allowance for doubtful accounts, right? And that sort of gets us to, as it were, our net accounts receivable. And essentially, that ADA account represented an allowance really to capture the fact that, hey, X percent of people aren't going to pay us, right? It's just the reality of the world we live in. In the same way, right, when we have note receivable, right, they will, when appropriate, create an allowance for there, right? So that's what it says here. If a company anticipates bad debts on short-term notes receivable, yeah, they'll have some type of an allowance. So just be aware, it exists for accounts receivable. We kind of specifically study it. The functional equivalent also exists for notes receivable. Right, so you can look at this CECL model. Right, again, it says, as with accounts receivable under the CECL model, companies consider all relevant information when assessing credit losses. It has to be reasonable and supportable. This is just saying like, hey, right, we recognize the fact that people might not pay us. You have to be reasonable in how you create that allowance. They talk a little bit about GAAP versus IFRS. You can read that, not too concerned about that for the exam because they're not testing that on the CPA anymore. Next, let's talk a little bit about financing with receivables, right? So we have our receivables here. And essentially what you can do, typically, right, there's two things you can do, right? You can use the receivable as collateral, right, for a loan, or you can sell the receivable, right? There's different kind of variations or nuances within each of these, but that's what's going on here, right? So let's look at these one by one, right? So first we're going to talk about using your receivables as collateral, right? So say that you're sitting on a bunch of account receivables, right? We have like 3 different clients who owe us money. That's great, right? If you think about it, these are assets, right? This is something you own. Somebody owes money to you. So one thing you can do, right, if this is you, the company, right, you can go to the bank or whoever, right, a party and say, look, please lend me some money, right? Please lend me 100 grand. And for collateral, right, in case I don't pay you back, right, I will put up these receivables, these things I own as collateral, right? So it's kind of like collectively all of my receivables, right? It's not a particular receivable on it. This is called pledging, right? You pledge it. Generally, all of your receivables as collateral, right? You're not going to really have any special accounting treatment here for it. So here's an example. You can read that guy there. This is in distinction to, or kind of another variation of, right, collateral would be if you assign your receivables, right? So maybe you have 3 receivables, right? One of them is for 100 grand, one of them is for 300, and one is for 1 million, right? The idea with an assignment of it is essentially you would specify, right, maybe this one or these two, right? It's not your receivables collectively, right? You identify specific ones that you're going to put up for collateral, right? And essentially what you do is you go to the bank or the appropriate, like the lender, right? So here's the company, right? Here's the bank. Please loan me this money, right? Maybe loan me, you know, 1.5 million or something, right? Let's just make it a bigger number. What then ends up happening is, right, first, when we assign it, right, we're going to specifically identify what or which receivable, so it's not collective. And whenever we get paid on this receivable, right, it's directly going to be sent to the bank, right? Now they can just take it over, right? So it says here the receivable became collected by either the parties, but normally what happens is you get the money, then it directly goes to the bank in that case. And one of the things here, right, you do have to be aware of is the bank, right? They're going to charge a fee for this, right? So they're going to have like interest plus a fee. They got to make money on this, right? If you have 1 million there, right? We're not going to maybe give you necessarily all of it, or right, we have to think about how can we make money on this. So maybe, right, we're going to collect on this, the 1 million, and then on top of that, you're going to make us separate payments. There's different variations on this. Let's look at an example here, right? So on December 1st, 2024, we got a company, right? They borrow $500,000 from the bank and they sign a promissory note with 12% rate there. The company, right? So they got the bank, they borrow 500,000. The company has an account receivable, right, of 620,000. Right? So what's going on here, if you're thinking about the bank's point of view, all right, a couple things. One is they're getting them, 500 and they're collecting on 620 potentially, right? Because when the money comes in, it's going to go over to the bank. And then also, right, they're going to charge, a fee plus potentially interest on giving that 500 grand, right? So here they're saying, oh, the fee is 1.5% of the receivables, right? So 620 times 1.5, there's 9.3. How do we deal with this journal entry, right? So remember, we're the corporation. In this case, it's going to be, we have the finance expense, right, of 9,300. We have now a note payable, right, because we borrowed money. So now we owe money, 500,000. And the difference here is going to be the cash that we get, right? So yeah, it's like 500, but because 9,300 is going to be the expense, like the net amount on that is going to be 490, Okay, so debit cash, we get 490. We got a expense there of 9,300. We owe eventually 500,000 on this. Okay. Okay, so then how does this work, right? It says Santa Teresa will continue to collect the receivable, right? So we had, let me just draw this the same way, right? We got the company, we got the receivable, and it will record any discounts, sales returns, bad debts, but it will remit the cash to the bank, right? So look, we will still manage it, but when the cash comes in, we're going to send it right over to you, Mr. Banker. So it then says, hey, on this receivable during the current month, the person paid us 400,000, right? So we're going to first have to account for this, right? Debit cash, credit account receivable. Then, right, we have to ship it over to the bank, right? So what we do here, remember I said, one, the bank makes money off the finance expense, and two, they charge us interest. So a couple things here is when we send the money over to the bank, right, the credit cash, it's going to be 400 that we got plus the interest expense on it, right? So 500,000 times 12%, 1 month has passed, right? The 5,000. So essentially what we do here is we debit interest expense, debit notes payable for the 400, credit cash for 405, right? We didn't pay the note payable off in full, right? We still owe, a remaining 100 on it. It was 500, but we paid 400. That's because we only got 400 from that customer. This is just showing you how that would be sort of done in a T account. Next, they talk a little bit about the sale of receivables, right? So we talked about using it as collateral. Now we're going to talk about a sale of receivables. And generally, right, it's going to be you have debit, cash, debit, whatever you get for it, right, at the fair market value. You get the receivable off the books, and to the extent there's a difference, right, you'll recognize a gain or loss. It's not much different than like selling a fixed asset or something, right? In this framework, right, with a sale, right, there's some kind of specific situations, right? One situation would be a factoring agreement, right? So it says down here, in a factoring agreement, the company, right, sells its account receivable to a financial institution, right? So we'll say F, financial institution. This person is normally called the factor. And it says the financial institution typically buys the receivable for cash, handles the billing and collection of the receivable, and charges a fee for the service, right? So essentially, yeah, we'll sell it to the factor, and then they'll handle what's going on for this. So we sell it, they buy it, and they're going to charge a fee for this service. Thereafter, right, they're responsible for collecting it. And they have down here, right, credit cards, right, like Visa and MasterCard are forms of factoring agreements, right? The seller relinquishes the rights to the future cash receipts in exchange for the cash from the buyer or the factor, right? So you can think about that with kind of like somebody comes in and swipes the credit card, right? How does that work with the business and Visa and MasterCard? On the flip side, right, another type of variation of a sale, right, would be when you have a securitization agreement or a setup, right? And essentially what happens here is, right, say we have our company, right, C1, they create a sub, right, or a different type of entity, like a subsidiary. Here it's called a special purpose entity, right? So we're going to do this on paper, create this special purpose entity. Then what we do is, right, we will sell our receivables to that special purpose entity. Thereafter, right, the special purpose entity right? They're going to issue things like bonds, right? Other securities on the open market, right? Like, oh, let's invest in this bond, let's invest. And in this way, right, whenever they issue the securities, they will be backed or kind of like serve as collateral on the back end. We will have the accounts receivable there kind of backing it up. It's kind of like mortgage backed securities, right? You buy a bond, they default, you can take the house or something. Here, you're this guy, right? You buy the security, the company too defaults, you can get those accounts receivable. Technically, right, this is a sale because we're selling it in between, okay? Some other sort of things to be aware of, right? So when we talk about sales, right, we said, one variation is a factor in it. Another, we can have a securitization. Another thing with a sale of account receivable is it can be with recourse or without recourse. What does this mean? Right? So, hey, we have our account receivable, right? We're going to sell to you, right? Maybe it's a bank or a person. They give us some money. What happens, right, after this guy gets it, right? He's sitting on the account receivable, right? So here he is with his new fancy receivables. Say that the person who owes on that receivable, right? Say there was our customer, our original customer, right? We'll just make her a girl. She does not pay on that receivable. Who is on the hook here, right? Is it us or is it the new guy who bought it? Well, it depends basically on the terms and conditions of the arrangement. If it's without recourse, basically this guy, good luck, right? That's your problem. You deal with it that the person isn't going to pay you. If it is with recourse, then we have a problem here, right? We're going to have to deal with, or at least account for the fact that she didn't pay you. So we're going to have to resolve that. And one of the things we'll do with the resource when it's with recourse is accrue a liability for it. And in this framework, right, all of this, right, you can read here. But whenever they make these deals, they negotiate these setups. Like the idea is like if it's with recourse or without recourse, there's different levels of risk, right? And with different levels of risk, we're going to have different sort of selling prices, different fees we charge. Those sort of variables enter into ultimately the transaction price on it. All right, so this one's a little bit of a complex example here, so let's unpack it slowly. It says in December 2024, they entered into the following agreement with a bank. The company transferred accounts receivable that had a book value of 600,000, right? So essentially we sold those to the factor. It was made without recourse. Immediately after we make this sale, right? The bank is like, look, we are going to only give you 90% of the 600,000, right? So that's going to be the 540. Okay. The remaining 10, right? We're going to do something special with this, right? Of that remaining 10, 4 is going to be a fee, right? Because we need to charge a fee on this, right? Which will be $24,000, right? If you put that into dollars, it's 24,000, right? 4% of the 600,000. And the remaining 6%, right? We're going to use that basically as a cushion against potential sales returns and allowances. In other words, look, these people might not pay us. We now have this receivable. it's without recourse, right? We need a cushion here to kind of help protect us. Then it says, after the factor has collected the cash equal to the amount advanced to the business plus the factoring fee, they will then remit the excess to the company. Accordingly, right, the company has a beneficial interest in the transfer receivables equal to the fair market value of the last 10% of the receivables to be collected, which management estimates to be equal to $50,000 less the 4% factoring fee, right? So let's kind of unpack this bit by bit here. It gets a little bit confusing, right? So we said first off, 90% they're going to give us upfront the $540,000. Then the remaining 10%, 4% is for a fee and 6% is a cushion. Eventually, right, when they collect the 540, what they gave up front, plus the factoring fee, right, once they collect that, then they say, essentially, we will give you some of the money back, right? And specifically what we will do here is we will give you the remaining 10%, which we value at 50K, right? So they kind of use a different subsequent valuation here. But, right, we got to back out the fee of 26, right? So if you're the company, what you get, right? One is 540 right now, right? Two is after they kind of collect everything they need to do, we back out the fee. Later, they're going to give you 26, right? So we're going to account for that later right here, right? So if you think about it, we got rid of the receivable and we got this. The difference, right, is going to be 34, right? You can plug that. Essentially, right, we took a loss on this. It was worth 600, but we only got, more or less 566 there, right? The difference is this was a loser. We lost 34,000, right? So that's a little bit complicated on there. Oh, my mouse is not corroborating right now or not working with me how I want it to work. Then they change the facts here, right? Same facts, except it's with recourse, right? We're going to have all of the same numbers with the same math we did, except, right, if we compare it, so, right, it's 540, 26, 6. That's great. 540, 26, 6. The difference here is when it's with recourse, right, we're potentially on the hook. So we're going to have to accrue a liability here, right? And they give us, the facts. They estimate it to be $5,000. So we will increase the credits, the right side of the journal entry, by 5, as well as, right, that's going to pump up our loss by 5, right? It was 34, now it's 39, okay? Finally here, transfer of note receivables. Then we'll talk a little bit about a bank recon, right? They do so much in these chapters, so I'm trying to keep it reasonable for you here. What's going on with this transfer of note receivables, right? Well, they say sometimes companies can obtain immediate cash from a financial institution, one, by pledging it, right, as collateral, we talked about it, or two, by selling the note, right? And then they have down here, we handle the transfer of note receivable in the same manner as the transfer of accounts receivable, right? So we talked about accounts receivable, selling it. You can potentially sell a note receivable, right? It says a note receivable can be used to obtain immediate cash by pledging it or selling it. You can also securitize it. One of the things here, right? The transfer of a note to a financial institution, right? So here's us, we transfer it to a financial institution. That kind of term there is going to be called discounting. And essentially what's going on here is, right, the financial institution accepts the note, They give the seller cash, right? So here we go. We're going to give you some cash for it. And what that cash is going to equal is essentially what we think that note is going to be worth in the future, right? The maturity value, what it's worth in the future, minus, in this case, right, a discount, right? And a discount, how we basically look at it here, it's going to be computed by applying a discount rate to the maturity value, and it really represents a financing fee, right? So there's really a fee here we're going to charge. Let's look at an example, right? Always better to look at examples on this. On December 21st, 2024, right? So it's on 12/31. Looks like we sold land in exchange for a 9-month, 10% note. We get a note receivable. That's great. The note requires payments of $200,000 plus interest on September 30th, 2025, right? So hypothetically here, on 9/30 of the next year, right? 12/31, we'll just say year 1 of 9/30 of year 2, right? We're going to expect collection on this. It then says, let's see here, the company's fiscal year end is December 31st. The 10% rate properly reflects the time value of money for this type of note. But hey, on March 31st, right, 3 months later, we discounted the note to the bank, right? So we did this guy right here. We sent it over. They gave us some cash. Really, that's based on what the maturity value of this note is minus a discount, aka the financing fee. How do we deal with this, right? And it says the discount rate here is 12%. So essentially, here we are, right? First thing we got to do is we've had 3 months that have passed, right? We have to accrue the interest on that note, right? So it's going to be the 200,000 times 10%. 3 months have passed. Debit interest receivable, credit interest revenue. That's great, right? Let me see if I could copy this. That would be nice if I could do that. All right, next thing, right? We have to figure out, right? We got to do this guy right here to figure out how much cash we got, right? So it's the maturity value minus the discount. Essentially, we got to figure out what is this note worth over the entire 9 months, right? That's the maturity value because, right, we're going to get the payback of the 200 plus the interest on it, right? So we got to do the 200 over here plus whatever the interest is, right? So the interest is going to be the 200 times 10% times 9 over 12 months. Essentially what this says, right, the maturity value is 215, right? So maturity value is 215. We then back out the discount, right, which is going to reflect these 6 months right here, right? So it'll be essentially the 200 plus the 15, right? So it's the held to maturity value, right? We're going to use that number we calculated right there times 12% times the 6 months, right? 6 over 12 months. That will tell us, in this case, this guy right here, right? The discount, we said it was 12.9. Right, so 215 minus 12.9, 202 must be the cash we got. You can look at that MCQ there. A couple things, right? So we said, discounted note treated as a sale, flying all over here. How do we deal with this, right? So we just calculated the 202, right? Debit cash 202. We'll get rid of the note, right? We'll get rid of the interest receivable. The difference, right? The plug in this case will be a loss on it. You can look at that, not too concerned about that guy right there. One of the things here they say is like, when do you know if it's a sale versus you're using it as collateral? The big thing here is if you surrender control, right? If you give the other person control, right? Do you do these three things? If you give control, then it's probably a sale, aka you can be refactoring the receivables. And we said when you do that, right, it can be without recourse, right? The new guy who gets it, they collect on it, it's their problem, or with recourse where, hey, we're going to have to accrue no liability on this, because if the underlying customer on that account receivable doesn't pay, we're going to have to deal with that. On the flip side, if we don't give control, right, we're essentially doing and using it as collateral where you can pledge it kind of collectively your receivables, or you can assign specific receivables. This guy just says, hey, whenever we have these situations, make sure you make reasonable disclosures. They have a GAAP versus IFRS thing you can check out. And then, because we're talking about receivables, there's ratios, right? So the receivables turnover ratio, that's telling us how effectively we're using our receivables. How many times do they turn over? Do we collect on our receivables in a period? And then this tells us the average collection period. How many days on average does it take to collect our receivables? We said, sorry for that, that these ratios only help in context, right? So here, right, maybe we have company one, right? We have the average collection period. Hey, on average, it takes them 58 days from when they make a sale on account to whenever they collect on that receivable. If we were to compare that with company two, right, they take 66 days. Well, hey, we're better, right? That's good. We're quicker, better. We get that cash inflow. But if we look at the industry average, right, we're behind the industry average. And if we looked at the average company, they're getting it almost like 12 days quicker than we get it. So you can see how these ratios can be used in a comparison capacity. All right, finally here, let's talk a little bit about a bank recon. Okay, so what's the deal with this? Essentially, right, we're going to have our cash that we track on the books, right? So we'll have like our T account for cash, right? We'll have that sort of ending balance on there that says we have X amount of cash that we use for our trial balance, our financial statements. And then we get a bank statement, right, in the mail that basically gives us a bunch of information, and then it ends up saying, hey, our cash is Y, right? Y amount. So it might be something like $100 and $70, right? They're different on there. The idea with a bank recon is we make some adjustments to the cash balance, we make some adjustments to the bank balance, and maybe both of them end up being $80, right? It's a reconciliation. How do we explain away these differences between them? A lot of it comes down to a point of view, right? We only see and know things from the company side. The bank only sees and knows things from their side, right? So how do we deal with this, right? So you're going to basically adjust the bank balance, then you're going to adjust the book balance, right? How do you adjust the bank balance, right? So you're going to essentially add to that deposits outstanding, right? So what are these? These represent cash amounts received by the company and debited to cash that have not been deposited in the bank by the bank statement cutoff date, and cash receives deposited in the bank near the end of the period that are not recorded by the bank until after the cutoff date. So what does this mean? Right, so this is essentially money from our point of view. Hey, we got cash, but we didn't deposit it in the bank yet. So the bank isn't aware of this when they made the bank statement. So we need to add it to their balance. Or alternatively, we deposited it, but the check hadn't cleared yet by the time the bank got it, right? So we're going to need to add that to the bank balance, to catch them up. We're trying to kind of connect the two eyeballs here, what we see with what they see. Likewise, we're going to deduct, that's too big of a deduction sign, any checks outstanding. These essentially, right, are going to be checks that we have written, right? We give somebody a check, and we've accounted for it as credits to cash that have not yet been processed by the bank before the cutoff date. Or alternatively, the people we gave it to haven't cashed the check yet. So what's going on here? On the books, we wrote a check, we subtracted the cash. On the bank statement, they don't know anything about this yet because the person hasn't cashed the check yet for it. So we need to equally subtract it from their point of view. Bank errors, right? This can be plus or minus. It's like when you're playing Monopoly, in your favor, not in your favor. Maybe we transposed the numbers or they screwed something up. How about the books, right? How do we and what adjustments do we make to the book balances? Right. Well, when we open up this bank statement, you can think of it like we're kind of like learning new things, right? Like when you get your phone bill each month, oh, I didn't know I made a long distance call, right? I didn't know that. Or, oh, I went over my minutes or something, right? So there's only certain things you're learning when you open up your phone bill. In the same way, when you open up your bank statement, we're going to have to adjust our knowledge for it, right? So we're going to have to add any collections made by the bank on behalf of us as a company, right? So maybe a customer paid the bank. We didn't know about this. One of our customers paid. We didn't know about this till we got the bank statement. So we got to increase our cash for that. Likewise, right? We got to deduct any service or fees, right? You open up your bank statement, goddamn, they charged me, a $20 fee, right? I didn't know about this till I opened up the bank statement. I got to reduce my cash for it. Likewise, right? We got to deduct non-sufficient fund checks, right? So what's going on here, right? Maybe grandma gave us a check for $50, right? For our birthday or something, right? We deposited that into the bank, right? And whenever we did that, right, that was great. We did a debit to our cash, right? We were like, oh, that's great. Thank you, grandma. Lo and behold, right, grandma, and this is like based off a Seinfeld episode, if you've ever seen this, right, Jerry's grandma writes him a check. Grandma didn't have money in her bank account, right? She wrote a check she can't cash, right? It bounced. So maybe grandma has $0 in her bank account. We open up the bank statement, we see this NSF check. That basically means grandma, right, that $50 check was a bad check. So we had increased our cash for it. Now we're going to have to back that out, right? And then finally here we have company errors. Again, that can go both ways, right? Maybe we transpose numbers, in our favor, not in our favor. So this is showing you, right? Maybe you open it up, you look at the bank statement, they say you have $70. On your books, right, it says you have $100. You make some adjustments, right? Maybe $20, maybe there's $20 for errors that are positive, right? So it'd be 7 plus 20 plus 20. We're looking at 110. Balance per book's 100, right? Maybe it was 15 for collections and then 5 for NSF checks. Oh, we're at 110, right? They both equal the same amount. This is a recon, right? We're trying to explain away these differences here. So here's an example, right? We open up the bank statement. They tell us we have 34,000. We look at our cash account, we have 35. How do we deal with this? Right? Well, starting with the bank statement, they say we have 34. We're going to have to add the deposits outstanding of 39.85. Right? We're going to have to deduct the checks outstanding of 5536, we're at 33,000. Okay. Then we go to the books, right? Our T account tells us we have 35,000, right? We open up the bank statement, we find out, hey, they collected some money on our behalf. That's great. Oops, they charged us a fee. Grandma, she wrote us a bad check. Oh, we transposed the numbers whenever we, calculated some stuff. There was an error. End of the day, right? We're at 33,000 for both of them on it, right? So this is just showing you, right? We start out different, but we end up the same. That's called a reconciliation. And one of the things with this is, right, we're making changes to our cash here, right? We're getting our cash balance to where it needs to be. So each one of these guys, right, like the 1120, we're going to have to go and make a journal entry for that to update our cash balance, right? So 1120 plus, the combo of these guys, right? Those are going to be a credit to our cash. We got to take it down, right? 3267 for those three things, right? So we got to build it up, take it down. Doing that gets it to where it needs to be. Finally, here they talk a little bit about petty cash, right? Usually this is like a de minimis, a very small amount of cash. You may have a little like box that you put it in. There might be like $100 in there. Sometimes it's easier, even though we generally want to use and record everything through checks, when it's like small amounts, right? Like we're buying a pack of pencils, it doesn't really rise to the level of needing to write a check for that. So that's the idea of petty cash. It's efficient, it's effective. So whenever we fund that petty cash, right, it's going to be debit petty cash, credit normal cash, right? So you can think of it like two separate cash accounts, right? Like our sort of baby balance we use on a day-to-day basis. We got to put $200 in that little like drawer we open. We will take it from our normal cash amount. And then we use the petty cash to pay for these little sort of like petty expenses, right? Like stamps and delivery, right? Later on, right, if we want to sort of replenish that petty cash, right, essentially what we do here is we will have all those expenses and then we will again kind of take it out of our normal cash amount, and you'll be able to replenish that petty cash. The last couple slides here, not concerned with this, right? I'll talk about at high level debt restructuring. This just says, hey, sometimes there is debt, you owe money, right? Things don't always work out as planned, and they can negotiate sort of differences in what you originally owed, the terms and conditions, versus what you now owe. And sometimes they can help you, sometimes they can hurt you. You can look at that. I'm not concerned with debt restructuring on the exam. Okay, so I'm going to end this guy here, this lecture.